Thank you so much for joining us. I might just wait a couple of seconds and see the stragglers coming in, but I really do appreciate you taking your time. I imagine this is probably your lunch break, so thank you for sharing that with us. And welcome to InvestSmart's webinar on picking the perfect ETF portfolio. If you're not too sure who I am, my name is Effie Zahos, and I'll be facilitating today's webinar. I'm actually InvestSmart's Chief Content Officer. Some of you may know me from the Today Show. I am their money expert or editor on that program each morning. And I actually did sit on the board for InvestSmart for a couple of years, and I only recently resigned to actually jump into this business. Back on the board, I was with some very, very smart people, and one of them, one of the brightest minds, is Mr. Paul Clitheroe. He's actually going to be one of the experts chatting today. You'll be able to see him there on screen. He is the chairman of the InvestSmart board, and look, Paul's had so many roles across his life. I know he started and was the founding director for IPAC, but I met Paul on The Money Show, and I've got to say that probably the best tip he gave me was not to bring your wallet when you go out to lunch, because I think one of the first times I went out... Let me finish, Paul. You definitely did that. We went out to lunch and you forgot your wallet. So that's probably one of his best picks. I also remember when I first went to the Money Show, because he started the Money Show many, many years ago, I think back in 1993. And my first job was to hold a flicky for him so he looked good. We were on a boat talking about how to be rich in retirement. So that was my whole job. But look, it's going to be very interesting to hear from you today, Paul. Some other bright minds, Alastair Davidson, he's the head of fund management for InvestSmart. And Alastair basically runs the show. If there is any, there's no question, I'm sure, that Alastair doesn't know around ETFs. So we'll be hearing from Alastair basically looking at the, what was that? Sorry, Alastair?
Just steady there, Effie. No, I'm not the smartest guy in the room, but Paul, right?
Oh, I think you're pretty good. Well, we're going to put you to the test because, look, I know that, our portfolios have done well. I'm also celebrating 10 years of happy returns. 6 of them are celebrating their 10-year anniversary. And they've done actually really well. They've outperformed their respective peers on average. And I'll let you go through those numbers, but I'll be really interested to see, what is it that we do so well and how can people replicate that as well. And last but not least, I want to introduce you to Tom. Tom Wilson is our basically our guru, our education guru, who runs all our boot camps. And he will introduce you to the tools that you need when it comes to picking your ETFs. The thing is, when you look at ETFs and just basically the amount of money that's flowing into them, it's quite astounding. Looking at some statistics, ETFs only listed not too long ago, about 2001, and we've got about 220 ETFs alone. It's the fastest growing market, and you can understand why there's so much interest in these. So, look, we hope you get a lot out of this today, and then basically we hope we act as your little nudge today to get you thinking about what you would like to do when it comes to your wealth creating journey. And I mean, let's get real. It hasn't been easy over the last couple of years. We had the RBA make a statement, obviously, yesterday, no rate hike. We've had 13 rate hikes in total. And, you can listen to so many different forecasters out there as to where they think the cash rate is going to go. I try and put those headlines, out of my mind, because at the end of the day, it's about trying to make the best of what you do have. Yes, 13 rate hikes, cost of living crisis, sticky inflation doesn't make it easy. But a lot of us, I imagine, have been really focusing on our budgets, and maybe our wealth creation has fallen behind a little bit. And that's okay, because I think the most important thing is you try and maneuver through what has been one of the most terrible financial times for most households. But there are some definitely good things coming forward. Lots of money changes happening on the 1st of July, and it's a case of trying to make the most of what you have there. And if you are in a position to start investing, then do it. There is no wrong or right time. It's more of, fear of missing out, fear of jumping in. It's a case of, putting a plan in and setting your goals. And that's what we want to try and jump in today. I want to start with Paul, first of all, because, Paul, you have been talking money for, 50 years, 60 years or something like that? Would that be right?
I didn't start when I was 8. Let's call it.
I know you've been talking money for a long, long time, and you've written several books and they've gone on to be bestsellers. But I guess for me, I'd be very keen to get your take on what you see how the economy is treating. What does that mean for households? And giving us a bit of your secret sauce as far as investment strategies.
Well, look, that's the thing, isn't it, really? I've been saying for decades now that really anyone promising you secret sauce is likely to be a crook. There just aren't any shortcuts in this business. Look, we can talk about managing risk, and obviously the economy is a really interesting thing to talk about. One of the primary challenges, I think, for we investors is trying to ignore some of the noise. It was probably easier for me, as Effie said, being talking money for 60 years. I turned 60. I do turn 69 shortly. So I guess I've been talking money since I was in my finished uni in my early 20s. It has been a long time. In many ways, it was a lot easier when I was younger because the noise was a lot less. We didn't have the internet, obviously, so we just didn't get the amount of noise about nearly everything. You can pick up any opinion you like. I could give you some world-class economists predicting the next share market crash. I could give you a whole bunch predicting the next share market boom. But all I really know and rely on is we've got some 7,000 years of history of capital markets. More formally, in the stock exchange, we can go back into the Netherlands in the 1670s and then into the big markets in Venice in the 1700s. So we've got many hundreds of years of history on share market returns, and obviously we've got thousands of years of history on property returns. The thing that I do know is putting aside some of this, and some of the noise is awful. Gaza, Ukraine, various feasts and famines in various parts of the world. Some of the noise is really awful. Really bad things happen. And but if we step back a little bit, let's face it, we do know this. And a dear old mate of Effie and mine, Ross Greenwood, has always been telling me that it certainly was the case in the money program, which we couldn't deliver this to Channel 9. But basically, the old newsroom story is if it bleeds, it leads. And that's wisdom from Ross. It really is the truth. Bad news kind of always gets bigger headlines than, things are plodding along all right or the economy's okay. So to be quite blunt with you, I don't get that stressed about the economy in the short term when it comes to investment because I'm not a short-term investor. What I get really interested in is demographics. I'm fascinated in population growth. And again, this year, go to something like one of the world, just go to world population measurements, and you'll see that the world population is going to grow again this year by about 93 million people. My apologies. That's actually, I should say, explain. That's births over deaths. Obviously, we're living longer. That's having a nice impact on deaths, and I'm pleased to be part of that. Thank you very much. But basically, when we get growth in population, we get growth in aggregate demand. And it's one of the simplest terms in economics. More people mean more stuff. So, for example, if you're a property fan, go somewhere where the population's growing. Obviously, Australia's population is growing, particularly through immigration. But where are they going to live? And then you go to jobs of the future, you go to education, you go to a decent coffee shop, infrastructure. So property becomes relatively easy. And the only way we choose areas of population growth. And the only way we can tamper with returns on property is through gearing. And gearing, of course, makes an enormous difference. The returns on property in decent areas are quite predictable at 3 or 4% above inflation. But you really can change your return with gearing. If we come into shares and go to any piece of performance data you like, shares on average will outperform property, but not by a lot, to be quite honest with you. Bonus shares, of course, you can buy a few, sell a few. You don't need to sell your entire house. Personally, I believe in a mix of these assets. And how do I change my returns? I change my returns through gearing. That adds risks to my investments. And I've got to tell you, turning 69 next month, gearing no longer plays a part in my life, but risk still does. For example, try and make this real for you. I see all this nonsense about as I get older, I should reduce my superannuation to a more conservative mix, blah, blah, blah. Well, that really is a load of crud when you set it alongside life expectancy, because I go to the tables and my wife, Vicky's likely to live much longer than I am. She's the same age, but that's just a male-female thing. But realistically, statistically, I should be around for another 15 years or so. So why would I come back to a low-risk portfolio of mainly cash? And all we do know is that cash over time is our lowest returning but safest asset. Things like property and shares, particularly property-geared shares, become our highest return assets. So we can't really tamper with this stuff much except through gearing. The one thing we can certainly have a huge impact, though, is the reason I joined InvestSMART as chair nearly a decade ago now. And the one piece of the argument I get is that returns are relatively uncertain, unless you're on term deposit. Returns are relatively uncertain in the long term. I would argue they're quite certain in the longer term, by which I mean 7 years plus. I know I'm going to get greater returns out of my property and shares than cash over 7 years. Next week, who knows? Who knows? Market may fall, market may rise. I don't much care. But the thing I can do is, of course, fees. And what excited me about the InvestSMART story was that if returns are uncertain and fees are certain, it just made sense to me that I should control what I can control. I can control risk through my gearing. I can control risk through my asset allocation, what percentage do I have in shares, what percentage in property, and so on. But I still believe in maintaining a pretty fully balanced portfolio. The only reason I'd go 100% to cash, really, is if I'm going to drop dead in the next few weeks. I think I'll look okay. Anyway, I had my blood test on me, all right. So basically, for me, the fee issue is particularly important. And this is where ETFs, I think, are a really exciting innovation in the world of investment. When I started out, to get into an equity trust was an 8% entry fee and around about 3 to 4% annual management fees. And we're not going back to the dark ages. We had electricity and everything. We're only going back 35 odd years. And so the ability to invest at the sort of prices you can do, and it's not only InvestSMART, by the way, it's fantastic, the organisations who are saying returns are uncertain, fees are certain, let's try and reduce the obvious drag on your investment returns, and that's through the fee profile. So I'm going to finish up by saying lots of noise out there. You can read horrifying stuff in social media at the moment. I'd encourage you not to cause that to stop your investing strategy. All I know is markets may go up and down this year, but all I know is the secret to creating wealth is you spend less than you earn. I know it's boring. I'm sorry. You spend less than you earn. You take that surplus and you add it to an investment portfolio with the lowest fees you can find and an asset mix that suits you. Now, I'm not going to make anyone rich quick here. It took me 40 odd years to get to a point where I'm not rich. I can't afford to live yet, for heaven's sake, but I can afford to live the way we want to live perfectly comfortably. And that hasn't been some, flicker coin. I get really cranky when people on the street say, "Hey, Paul, you're from that money show. Give me a hot tip. Give me a hot tip." I always say the best tip I can give you is be nice to your mother and don't stand in a canoe, because at least they're true. All this other short-term crap is just crap, Returns are returns. Miracle returns don't exist. You'll get ripped off if you do chase miracle returns. So let's invest sensibly. Let's try and put money aside on a regular basis. Let's use gearing if you want to change your risk ratios. Quite happy with gearing in sensible assets. But the thing for me today is what an opportunity we all have to have our money invested cheaply, efficiently, and effectively all over the world. So for me, lots of bad news in the media today. But as a long-term investor, this is just fantastic. I can access not ridiculously high returns. That's more Golf 5 racing. I can access decent returns over time at low fees, and I can do it really easily with really good reporting. And that, for me, is a far better world. So from an investment viewpoint, I just shut out some of the noise that's rattling around you. Oh, the market's going to fall tomorrow. I mustn't invest. Property's going to boom. Property's going to bust. Shares are going to go. Look, no one's got the first clue. If you're in publishing, the best way to get a headline is say something crazy. Paul Clitheroe says shares will double next year. Paul Clitheroe says shares will halve next year. I promise you I'll make the media, but I promise you it's also as unknown to me as it is to you. Thanks, Effie.
Yeah, thanks, Paul. And Peter actually says, if you have 20 or 30 or 40-year time frame, then growth assets are the only way to go. So kind of, go along what you were saying in the market rather than timing it. But I've got to ask you, Paul, I think you introduced me for the first time to what you called that wealth clock, the population clock. And people can go online. The ABS actually has that clock that shows the tick up on population. I think it goes up by one person every 46 seconds. And you can check that out. There's an ABS one on there. There's a death clock as well. But you raise a good point. You have an increase in population, a bigger demand on things, and that pushes money. Money goes around. People want more things. Businesses do well, and so on. But it has a bit of an adverse effect as well. The affordability on property is a big issue that I'm sure a lot of listeners are probably interested, a little bit of thought around that. Property prices making it affordable. And on the investment side, I think you raised some good points. If I can just reiterate that, if we do have a population growth, then you've got things, construction needs to be done. So you look at companies that are in construction, healthcare, the Ramsays of the world, telecommunication, maybe Telstra's of the world, and so on. But I'd like to get your thoughts before I move on to Alastair and then jump into these ETFs. On I guess the winners and losers for population growth, especially when you look at affordability of property.
This is sort of, I guess, a bit like hard language in many ways, because the reality is that my age group have been enormous beneficiaries of this thing called population growth. As Australia's gone in my time from 14, 15 to 16 to 25 million. And it has been, there's no getting away from the fact that when my wife Vicky and myself bought our first property, 42 years ago, I think it was $90,500 for a little semi. That's not the important number. Inflation makes that number very different. What's important is affordability, which you raise, Effie. The problem is that neither I nor anyone else in terms of property affordability, the only solution that we're hearing, in fact, is the right solution. You can only impact supply. And so what we're seeing in whether it's the New South Wales budget yesterday or the federal budgets around the country, the only thing that we can really work on to make property more affordable really is supply. Look, the challenge here, though, and this is a really hard one, so you could say, well, gee, if Australia's population was smaller, that'd be less demand for property and property would become cheaper. And that's true. If we, for example, our birth rate is struggling to see us move forwards these days. So if as a nation we cut out immigration altogether, over time, like Japan, we start to see a fall in population, and that would certainly see a difference in property prices. But the problem is that we're not getting any real economic growth. We're not getting much productivity growth. We're an aging population. People like me are working less and less, as I plan on working part-time for many years to come, but I'm no longer working full-time. And so the challenge that I think our policy drivers have in this area is that what we have is we have a large, millions and millions of Australians who own a house who don't want it to fall in value. And we have millions of Australians who would like to buy a house and would like to buy it more cheaply. This is very difficult politics, Effie. And obviously the growing population has a major impact on that. But I think we also need to be careful. I mean, what about nurses? What about aged care workers? What about someone to actually make that cup of coffee I'm talking about? The reality is, in an aging population, young, vibrant migrants are actually a pretty important part of this. And also, who builds all these houses, by the way? I was down in Adelaide recently with the Adelaide Premier at a conference, and we had a bit of a chat about this very issue. And in Adelaide, there used to be a saying, in fact, his housing minister was telling me, hi, Adelaide folks, but what he said to me is when he was growing up in Adelaide, it was easy. You couldn't get a job, but you could buy a house easily. That's no longer the case. Adelaide is something like the Premier was saying, something like 23,000 jobs short in the construction sector alone. So more people getting paid well puts more demand on housing prices. So we've got a conundrum. What I would say to you, though, Effie, is that most Australians at the moment who want a job have a job, and probably not a badly paid job. And the only way we're going to try and fix this property issue is, and I think our policy people have got their hands on the right lever, we've got to somehow increase the supply of housing. We've got to somehow increase the supply of housing, particularly affordable housing. So basically, that's great. What I'm struggling to see at a practical level, though, is that who actually is here tomorrow to start building those houses on top of our existing workforce? And that probably comes down to immigration. And as someone said, well, hang on a sec, if we bring some young builders in, they'll need to live somewhere as well. So this is a very, very tricky issue. But basically, what I would say in terms of this cost of housing issue is that I really wonder, and certainly I see many young Australians who now saying, well, what about the more regional city? What about in New South Wales case, Wollongong, whatever. So this is not an easy issue, but driving housing prices down bluntly while the population is growing is not going to happen. And the other big roadblock, by the way, is people like myself in the previous generation, we were getting close to a life expectancy of dropping dead. And that freed up housing quite dramatically as well. But now when I go, you mentioned the death clock, when I go to the death clock, if I lie about how much I drink, the death clock gives me about 90. In reality, I'm probably, life expectancy probably closer to 85 if I don't drop dead tomorrow. But interestingly, Vicky is well into her 90s. And this leads to an even bigger issue of parents transitioning money to kids that, do I want to drop dead or Vicky drop dead and leave money to 75-year-old children? And this also leads to their housing affordability, freeing up housing. So there's a bunch of challenges here, Effie, but I'm actually not arguing with our politicians and policymakers at the moment. The only contribution you can really make is you just got to try and increase the supply of housing. And the reality is that's going to upset a whole lot of people because we all want more housing, but not in our street. And that's going to cause some interesting ructions in our society. Basically, the need to be more houses where people want to live, and that's going to rattle the cages of people my age. And I'd say to people my age, kind of suck it up, We've had it pretty good. We're going to need more housing where people want to live, and that may mean, we don't have a quarter-acre block of land on a hill's hoist with the same house next door. Basically, the world's got to change.
Yeah. And Paul, this is actually great leeway into Alastair, because you were saying, younger people are looking more in regional, and the data that I saw even yesterday is showing that young people are going out to regional suburbs, building their lives there. You need, let's face it, you want to buy property in Sydney, you need a $200,000 deposit to meet the 12% LVR. That's a lot of money. But I am seeing more younger people starting to invest. And this is where, you look at the number of people that have jumped into exchange-traded funds, over 1.5 million Aussies are. It is a way to build wealth if you're not jumping into property. So, Alastair, you head up our funds under management. It's a big role. And I may say you are doing very well there with your team. But talk us through what you're seeing as far as from our portfolios and the strategies and our philosophies and what we look at.
Thanks. Well, what I'd like to start with, if I could just go back a few steps, just I'm not quite sure how educated our audience is, but just to start with what ETFs are and to go back to what we were going to talk about. Exchange-traded funds are effectively just funds that happen to be listed. So, there's been a managed fund industry, as Paul will tell you, for at least 50 years in this country. You can buy managed funds on virtually anything, equities, bonds, private equity, commodities, etc. What's happened in the last 25 years is that these funds have now been listed, which makes it a lot easier and a lot simpler for people to buy these funds. There's no bits of paper, effectively. So why would you buy an ETF? I mean, typically it's because you can get a exposure to a whole basket of shares or to a particular commodity that's much simpler than just trying to buy yourself. So you can buy a gold ETF, for example. To buy physical gold is actually quite hard because you've got to find it, store it, keep it somewhere safe. You can buy a gold ETF with a click of a button, and it's yours. And you can buy them relatively cheaply. So you can get, a whole portfolio of shares. You can buy the ASX 200 for less than $50 in one trade, which gives you a small fraction of every company, but it's much easier than trying to buy 200 shares and buy them all on your own broking account. And also, if you're not sure, so what we're really talking about is ETFs. And if I'll flick to the next slide, because I think people should be aware of what the different sorts of ETFs there are. So going back to what Paul had said earlier on, one of the main things at InvestSmart that we look at is how do we keep the cost of investing down? And the easiest way to do that is to buy index funds. And index funds, there's been a whole lot of studies from some very well-respected authors and finance houses that it's very hard for active fund managers to beat indices. So they've done studies over the 10, 15 years. There is less than 10% of fund managers can outperform against an index. So by and large, if you can't find a good fund manager, and it's, as we all know, it's very hard to pick them. There's thousands of very good fund managers out there, but finding the ones that will outperform is even harder. So we tend to buy index funds. There are other sorts of ETFs that have just come into the market more recently, which is what they call smart beta or factor. Now, these are ETFs. These are funds that use effectively an algorithm or a quantitative model to say we're going to pick high dividend yielding shares, and they use a mathematical model or an algorithm to try and pick what those shares are and rebalance it. They can produce better results, but again, they don't necessarily outperform all the time. And the third category, which is probably more recent, happened in the last 10 years or so, is that there are now active ETFs. So that's effectively people like Magellan, like Platinum, like ourselves, Intelligent Investor. We have funds that are listed that actively pick and sell stocks. So we have portfolios of 20 to 35 stocks. We have 4 of these funds, but we are actively trading these shares. We're actively trying to pick the ones that will outperform so we can outperform the market. But to sort of reiterate a point that Paul had said earlier, the fees are lowest in the index funds, which is why we tend to use index funds for our portfolios. As I said earlier, there's, as you said, Effie, there's over 370, about 377 listed ETFs now on the market.
Alistair, there was someone, sorry to jump in. Oh, sorry, Alistair. There was, if you could just, before you jump onto that, there was a good question there. I think maybe let's just set up how we differ, who we are, InvestSmart. So a question there from MK, if you can see that, how are you guys different from Sharesies and other portfolios? Well, Intelligent Investor's part of us. So, do you want to just take it back a step as to who we are?
Well, effectively, we're very similar to Sharesies. But you can buy portfolios of ETFs or have suggested portfolios from BetaShares does it, Vanguard does it. There's a couple of other providers implemented portfolios. Where we're slightly different is we actually give you a portfolio of ETFs, but we can purchase it. We've got a very low-cost brokerage arrangement, and we can provide an overall tax statement. So Sharesies, I think Sharesies does something similar. Where we are significantly different, which is something that Paul Clitheroe had been suggesting we should do for a number of years, and we introduced about 5 years ago, is we cap our fees. So we cap our fees at $550 a year, which includes GST. So we charge 55 basis points effectively. So if you've got more than $100,000, you don't pay any more than $550. So that's probably the significant difference that we have compared to Sharesies and Vanguard and BetaShares and the other providers of portfolios. So I think to go back to where we were talking in ours, I mean, there was the number of ETFs. So there's a whole variety of things you could buy. There's been Bitcoin ETFs available in the market for the last 2 years. I think there's another one just about to list tomorrow. You can buy Ethereum, which is another cryptocurrency. But what ETFs effectively allow you to do, and this goes back to how would you build the perfect portfolio for you, you can buy ETFs that gives you exposure to virtually all the asset classes. You can buy ETFs that gives you exposure to all the different markets. So you can pick what you think is what you think is going to go up or what you want to have in your portfolio by using ETFs. And it comes into specific themes. You can buy healthcare, electric vehicles, exposure to crypto exchanges, which is what a BetaShares has got. So there's an enormous variety of things that you can pick. So I think that then takes you to, why would you pick more than one ETF and how would you pick them? So it really comes back to what you're trying to do and what your goal is in your investing life. If you wanted to say, pick a market, you say, let's say, the Indian elections just happened and you believe that, now Modi has been re-elected, that there's going to be a boom in the Indian market, which is, a lot of people believe that. You can buy an Indian ETF with a click of a button and have exposure to that market. What we suggest in our portfolios is that it's very hard to pick markets. As Paul mentioned earlier, there are 100 economists, and every economist will give you a slightly different view, and some of them can be completely different to what one guy says the market's going up, the other one will say the market's going to go down. Currencies are going to go up, currencies are going to go down. What we believe you should do is you should have a balanced portfolio which covers all the major asset classes and is basically maintained to give you that balanced exposure throughout the life of your investment. So we have in ours, typically, the models that we have cover conservative growth, high growth, balanced assets. We have also asset-based models that cover interest income, international equities, hybrid, fixed interest, and then we go on to, there are a variety of markets that you can pick. So we have a choice of 10 different portfolios in our market. So we're trying to cover all the main asset classes, but we won't tell you typically whether to buy an Indian ETF or a China ETF, because we don't think we have that skill base, and we don't think there's very many people who have that skill base to be able to pick those particular markets. So the most popular portfolios that we have, so this is based on the number of people who invest in these particular portfolios, is the high growth, the growth, and international. That's probably more of a reflection of our audience, of our client base, which they're typically investing for the long term. As Paul said, you want to invest for longer terms, because that's where effectively you get the benefit of the compounding of your investment growth. So if you've got a portfolio that's generating 7 to 8%, as that compounds over time, every 10 years that value will actually double. So with high growth and growth, which is typically in equities, which are the higher growth assets, that's the sort of returns that you should expect. So just to give you an idea of what our high growth model has done, this is the 1 year, 3 year, 5 year, and since inception. As Effie said, we'll be 10 years in October 2040. What we tend to do is we compare ourselves to other funds that have a high growth return expectation. We get a lot of data from Morningstar. So we compare this data every month to see what our peers are doing. We also look at what our peers have actually invested in, and we tend to match what our peers are doing, because we don't believe we have the secret sauce for picking which markets or which assets will outperform in any particular time. So we tend to go with what's the wisdom of the crowd, effectively. So if everyone typically has 70% of their assets in equities, 20% of their assets in bonds, and 5% in property, and 5% in cash, that's what we will match. And we will adjust our portfolios every quarter to make sure that we're tracking what the average of all the peers do. Now, what that means in the long term is that as long as our fees are lower than everybody else, we will outperform all those other fund managers. And I think that's what these numbers tend to show you. So that excess that we produce to the peers is effectively what's been happening, because we only charge a maximum of 55 basis points, whereas the average of the peers is approximately 1 to 1.5%. We will always outperform all those peers by close to 1%, as is showing. Now, that 1% difference actually compounds as you go through time. So our 1% outperformance each year will add up to be 2 to 3% over 5 to 10 years. Now, markets go up and down, and sometimes, our asset classes are not quite exactly right. But on average, we believe that picking portfolios which track high growth and trying to do it for the cheapest possible price, which is what we try to do all the time, will give you better performance than trying to do anything else. So that's our high growth, our growth model. Again, it's got similar numbers. We're outperforming our peers. We're producing, 6.8% since inception as an annualized return. It's effectively what we expected it to do. We don't expect these portfolios to produce 10 or 20% over the long term. That would be our expectation of a long-term return, is that 6 to 8% for the growth model. 7 to 9% for the high growth model. And then for single asset models, we do have an international model, and this is primarily available or used by people who have a lot of exposure to the Australian equity market. So if you've got Commonwealth Bank shares and you've had them since the float, that could be a big part of what you've invested in. Now, you don't necessarily want to sell that because that would crystallize, say, a big capital gain. But what you could do is add an international model, which then gives you exposure, diversifies your asset base out of Australian equities, and gives you extra. Now, what's interesting about this international model, this is a model that owns ETFs on international equities. That studies that have been done on fund managers outperforming, it is more apparent with international fund managers that they underperform on the index all the time. So we've got an average, there's 900 different other international fund managers that you can buy in Australia, and we've outperformed them by a substantial amount because, one, they charge quite high fees, typically 1.5% to manage your money, whereas we're using index funds, which usually charge about 10 to 15 basis points. So we expect to outperform by about 1.5% every year, but because these fund managers typically underperform the index by quite a lot, we've outperformed by more. So this is probably a very good example where using ETFs, index ETFs, are much better than trying to pick a fund manager that actively selects shares. So what's in our model portfolios? This is the sort of ETFs that we have in our high growth. So we've got 2 Vanguard models. We've got a couple of iShares models. We've got the AAA cash ETF. And we've got an infrastructure model that we've got from VanEck. So we use about 6 to 7 ETFs in each of our models. What we're trying to do is obviously limit. You could have 10 or 20 ETFs, but then your transaction costs. So going back to what our main mantra is, you've got to keep your cost as low as possible. We have preferred brokerage rates from our broker at $4 a contract note, so we keep the costs very, very low. We do as little turnover as we can because there's a bid offer spread and buying and selling ETFs. So
I was going to ask you that, Alastair. The frequency of changing those ETFs, the parcels, we don't move that often, do we? Because of that very reason, keeping the fees down.
Very little. We're doing a bit of analysis the other day just to see what our, an average portfolio manager, an active portfolio manager will turn over their portfolio probably 50 to 100% every year. In these ETFs, we're probably less than 20% is what we've estimated, but we think it's about 15% turnover. And that's, the buys and sells. So that's effectively, and we don't sell out of any ETFs on that, very often. We're typically just rebalancing to say international equities have gone up by 20% in the last year, so we're now slightly overweight. We should probably sell some of that just to come back to our ideal asset allocation.
Yeah. And if I can just ask, sorry, I was going to say, Harry's just on the funds here. Just wanted to know, do we pay regular dividends to the investor on any capital growth?
Yeah. So what ETFs will do is ETFs, as a managed fund. So managed funds have a particular tax process. So just to explain the difference between, say, a listed investment company and a managed fund. A listed investment company can buy and sell shares all day and then distribute what they want to distribute, usually a fully franked dividend. What an exchange traded fund, which is a trust, a unit trust, under Australian tax legislation, they have to distribute all of their income and all of their capital gain in the year that it's crystallized or received. So when you get a distribution from an exchange traded fund, it's typically the interest that they may have received on any cash component that they've had. It'll be the dividends plus any franking credits that they've received. It'll be the international dividends if they have those, less any, including any withholding tax credits that might be attached to them. And then any realized capital gains, less any realized losses that they have. So these funds will pay regular dividends. They'll pay, typically they pay semi-annual. If they're equity funds, they'll pay quarterly if they're bond funds. If it's a cash fund, it pays monthly, like the beta shares AAA fund. But the distributions are regular, but they can have different component parts in them, which is another point which we'll come to, which is that, why would you use, and it comes back to, why would you use something like Sharesies or Beta Shares or Vanguard or InvestSmart to buy a portfolio of ETFs? One is you can buy ETFs through any broker. You go to ComSec, NabTrade, Bells, JB Ware, they'll buy ETFs for you, and you can hold them in your broking account. What happens with ETFs is, though, as I just mentioned, that tax statements can be relatively complicated because you've got a series of components that you've received, being it interest, dividends, franking credits, maybe some capital gain. So what investment platforms like us do is we will give you a consolidated tax statement. We'll make that tax reporting much simpler for you. And we can offer much lower brokerage rates than you can get at, say, ComSec. So, as I said, because we are dealing for a large number of people, we've got a very preferred rate with our broker at $4 contract notes. ComSec, which I use sometimes for my personal account, they still charge me $29 or $19 if I've got volume. Bell Direct are the same. So we've just managed to get it done. I mean, there are a few other groups. Stake, for example, they can do low cost brokerage, but they don't necessarily give you the tax statements or help you pick which of the ETFs that you should have. That's primarily why you use a platform.
Thanks, Alastair. There is one question I do want to touch on, you, and you mentioned it just briefly. The thing is, if you're like me, I kind of collect a lot of ETFs. Every time something happens or comes out, I'm as a journalist, I read it, write it, and then invest in it. So the issue with an overlap there, how do you avoid that? And even looking at our own portfolios, how do you know what marries up very nicely? And I know, Tom, you're going to go through some of the tools that we've got, but this is a question that's come through Eugene: how to limit overlap or owning too many different types of investments? Your thoughts on that?
So just to explain, how do you get an overlap? Well, let's say there's about there's probably about 7 or 8 different Australian ASX 200 ETFs you could buy. Now, if you bought 3 of them, you would have virtually the same shares in each of them. So what you're trying to do is to make sure that if I buy an ETF that's got Telstra in it, I don't want to buy another one that's got Telstra in it, because then I do have an overlap and I've doubled up on my exposure to any particular asset. So what we tend to say, what we do say to people is, like, if you're going to buy an ETF, buy one in a particular market. If you're going to buy, you can buy a global. So where you tend to get overlaps, which you've got to be a little bit careful about, is if you're buying a global ETF, for example. So there are ETFs available in Australia which include Australian shares as well as international shares. So it's designed to say you can buy everything, the whole global equity market. So what we tend to say is, look, don't necessarily buy an MSCI index, because that would include, say, Telstra, Commonwealth Bank, possibly BHP. But buy an S&P 500 index, which is just US, and buy an ASX 200 index. And that makes sure you don't have any overlap between the two. So I think, as Tom will mention later, we do produce an ETF report. We rank ETFs. We have a process to go through to make sure that we're always picking the right ETFs. We tend to rank ETFs on liquidity and the fees, the size of them, and how well they track their index. But effectively, it also tells you that if you're trying to buy a global index, use this one. But if you're trying to buy just global shares which don't include Australia, buy this one. So we tend to separate ETFs into what categories you should fit them into. And that helps.
Can I just jump in there quickly? I think, folks, what we've got here is a really interesting question, and you need to think about your money personality, because I'm very respectful of people who really like to sit down, and for many people it's a really fascinating hobby, by the way, of running their own spreadsheets and running balances and make sure they don't get overlap. And I'm very respectful of that model. But for me, money's kind of what I've worked in all of my life. And so my money personality is, despite the fact being the money business, this is where personally I would rather an InvestSmart or, with my super, an industry super fund. Why did I mention industry super fund? Low cost, once again. But personally, I just wanted to make the point, Alice, that I think a lot of this, because what you're saying really does sound quite complicated. And I know, Effie, you as a journalist say you pick up bits and pieces. I just find if I pick up bits and pieces, I just end up in a hell of a mess. Personally,
I might have exaggerated that a little bit, Paul.
Yeah,
it's not a mess. My portfolio is not a mess.
Yeah, thank you, Effie. I'd rather go to an InvestSmart or, with my super, an industry fund, whatever, and I'd go, look, my risk profile is probably growth, close to high growth. And so really for me, one way I solve this issue is that I actually let someone else do that for me. And that, I think, is the important issue. I've seen a couple of questions flash through about, minimum investment and InvestSmart and so on. You've seen a few answers come back. But I'd strongly encourage you to think about what's your money personality. I actually don't think you're going to change your returns very much, by the way. But I've got a lot of friends who literally like to spend a couple of hours a day dabbling around with their investments. They think it's wonderful. That's kind of what I do for a living for other people. If I've got a couple of hours, I'd rather go sailing, take the dog for a walk or play golf and let someone like Alastair and the team worry about what's in my growth portfolio. So I think there are I think you'd agree, Alastair, there are kind of two quite different ways of doing this, being very self-directed, meaning you're really into it, or maybe like me, you prefer to play golf in your spare time and you're kind of happy to have a pro do it for you. Do you think it's reasonable, Alastair?
I think that's probably a very someone described it. The ETF portfolio approach is sort of a lazy way to do it, and it's if you don't want to spend a lot of time, you'd rather be on the golf course, which you and I probably agree with. So it's do it. I've invested in the InvestSmart portfolios, and I personally think ETFs are much easier. I don't have the time to try and pick stocks.
Yeah,
and it's got to be an interest. It's a hobby for some people. Some people love it. I mean, I have a number of friends who love picking stocks and love discussing them and spend hours talking about them. Not for me.
Yeah, and on that note, Paul, you're right. You got to know your money personality. You got to know your risk tolerance. Which this is why we've got Tom here now, because we actually do have a great little quiz that can. It only takes a moment or so. You fill in. It lets you know what your risk tolerance is, and then matches things up. So, Tom, I think I'd love to hear now from you as to so we've found out what ETFs are. We've looked at the different portfolios. What free tools are there here that we can actually use to guide us?
Yeah, it's been great because literally all the problems that you've talked about so far, economics, but also talking about the idea that, we want people at InvestSmart, if they want to do it themselves to save money, great. But the reality is that once they realize the intricacies, like Paul mentioned, they realize that their time's worth more and we can do a better job and we can actually deliver it cheaper. Like even buying the ETFs, we've got, institutional price brokerage. And that's one thing I was going to say here as well. Obviously, a lot of the problems that we've had in the economy that we're all experiencing, it does come onto our well-being. One way that a lot of people are trying to fix that, particularly corporations, is trying to increase that financial literacy and trying to improve that, which flows onto well-being. But enough of the stats, because what I can do is I'll get to those tools. We do run the online bootcamp course, which is the one that you were talking about. It's a 7-module online course, and we've actually got a discount code coming up because it covers off literally everything that yourself, Paul, and Alastair have been talking about, explaining the difference between index, ETFs, etc. I'd say, and this is something that's already been echoed. It's the top money lessons that we hear from people that do the course, and we get a lot of feedback, which is fantastic because it's constantly evolving. But they say, and it's a bit of a garden thing, but start early and start small. So definitely start when you can, when you're much younger. Diversification, and that's the one thing that I know my friends, they say, oh, you work at InvestSmart, you work with Effie and you work with Paul and Alan Kohler and everyone like that. What's the hot tip? What do they say? And as Paul says, it can be a bit boring, and it can be that diversification's the key, slow and steady. You're not trying to get rich overnight. So we really try to push that in boot camp and let you know that that's the norm. That's what you should be aiming for. And the regular contributions, watering your financial garden. So making those regular contributions, whether the market's up or down, you ignore the noise and you plod along, carry on, keep calm and carry on. What I'll do is I'll show you these tools. So it's probably about 5 or 6 minutes. I'll run through how to find with the ETF filter tool, and then also that statement of advice, or the portfolio picker, we call it. So let's check out the ETF filter tool. I can go up to Insights here and down to ETF Insights, then go to Compare ETFs. So I could easily type in something like robotics, and I'd get any kind of ETFs that actually have the name robotics in their security name. But I'll reset the filter because I want to try and find ETFs that track the ASX 200. So I'm going to go to the management type and choose ETF. I'm going to leave the keyword search. Geographical focus, I'll stick with Australia. Asset allocation type, I'm going to choose equities. The InvestSmart rating, I won't choose anything there, but with category, I'm going to choose Equity Australia Large Blend. Now, I want to choose some of the bigger ETFs, so I'm going to stick with a market cap of more than 2,000 million, which is $2 billion. So I'll type in 2,000. And so with order by, I'm going to click on the InvestSmart rating and have it set to descending and compare ETFs. So we'll have a look at the InvestSmart star rating, and you can see there's a number of different factors that are taken into account, including the size, the funds under management, the fees that are charged, obviously lower the better, the liquidity, so the trading volumes, how easy it is to buy and sell, how liquid it is, the spread, so that's the difference between the bid and ask, or the buy and sell price, obviously tighter the better. And then the tracking error. So the difference in the return profile of this ETF to its actual benchmark. We want it to be as close as possible, obviously. But you can see here on the left, there's the ticker codes, and there's also the security name. So you can always search Google with those terms and find out more information from the ETF provider themselves. The MER is the management expense ratio, and then there's various prices of each unit of an ETF here, along with the yield for 1 year, and then a return profile over a 3-month, 1 year, and 3 year period. So there's definitely a lot you can do with this tool, and you can search to your heart's content. But now we'll have a quick look at the portfolio picker, and you can get to that through one of the investment hubs. Go to Goals and Planning, Investing Goal Hub, Saving to Build Wealth. And we've got a lot of information on these pages talking all about the profiles, the portfolios. I'm going to skip down though to the investment planner. So if you want a portfolio recommendation, this is where you can go, and we'll click Get Started. And I'm going to choose Building Wealth. Here I can give a unique name to my goal. I'm going to go with the Margarita Fund because that's very important, and click Next. Here I can enter in my initial investment amount. I'm going to stick with 10,000. And do I actually have a goal amount in mind? Well, it's always good to have a goal. It's part of a well-formed investment plan. So I'm going to say yes. I've got $25,000 that I want to save up for. So I'm going to click Next. Would I like to set up any monthly contributions? I can always skip this, but as we all know, a good investment plan also has the ability to regularly contribute, almost automate your investments. So I'm going to add $200 and definitely put that dollar cost averaging to work for me. Now, this is a very important part. Obviously, it's the time frame. How long am I looking to invest for? Let's go with a medium term of 5 to 7 years. And it's given me a recommended risk profile based on the information that I've generally entered into it. I can skip forward and see some other profiles like a high growth and a balance, which is a little bit under what was recommended, and even a conservative if I want. So all the options are actually shown there for me. I'm going to stick with the recommended risk profile of the growth and click next. So now I can read more about my portfolio that's been recommended to me. And I can see on the left-hand side here the actual allocations in terms of the weightings inside this portfolio and the projection, along with estimated fees, particularly the InvestSmart capped fee. That will be definitely explained to me in there. If I wanted to scroll down a bit further, I can get my investment plan, and this might take a while, so I'll try and speed it up. So now I can review my investment plan, and there's obviously some details that I need to confirm before my investment plan or my statement of advice can be issued. And I must read through these different points here. And obviously there's the product disclosure statement, the PDS, very important. You should definitely read that. And the target market determination, that's very important too, and you should read that also. There's the investment plan here. I'm going to read it and just see what it says. So it's created a tailored statement of advice for me, and I can now read through this and get all the information that I need about the advice that's been given to me, particularly what it doesn't cover and what its limitations are, but also how I can go about my target asset allocations. So I've got obviously the growth model, and I can get some more information about that. And if at any point I need help, I can always reach out to InvestSmart and talk to them either through the online chat, which is at the bottom right here. And I can also use the help center, or I could always give them a call and they can provide general product advice. If I want more specialized advice, I can always seek some more financial advice through a licensed financial advisor. So if I'm happy with all of that, and I can click the I've confirmed that I've read all of those important documents, I can actually go along and start my investing application straight through this tool itself. So thanks for having a look at that tool with me, and we'll get back to the webinar. So that's the birth of the Margarita Fund, which is fantastic. And one of the comments was, can you put this up on the website? If you know some good margarita bars in Sydney, that's for sure. We'll put this up on YouTube. I was about to say,
Tom, 7 years for a margarita, I'd shorten it.
But yeah, we'll put this up. Who knows how much they'll cost in 7 years' time. But the thing is, yeah, we'll put that up on YouTube because that's such a good tool, and it's free to use. A lot of our tools we have at InvestSmart are free, have been created for these reasons. But this is what we talk about in bootcamp. We do live weekly webinars. We get questions all the time, and you're welcome to actually try it out. Normally it's $99 to join up, and you get 1 month complimentary access to Intelligent Investor. So the stock recommendations, stock research, Alan Kohler's, articles as well. If you use a code, go webinar_50, or there's the QR code you can take a photo of, and go to investmart.com.au/bootcamp, and you can enroll and enter that in there.
Thanks, Tom. Thank you so much. Remember that those star ratings on the ETF you can download. That's a free report on there. There are so many questions. I'm mindful of the time. We won't be able to get through all these questions, but rest assured, a lot of these will be great inspiration for myself and Maria to put into stories for our newsletter. That is free. You can sign up to that. That comes out each fortnight, and there's some great ideas there. I do want to at least hit one question or one more round with the team here, and I might start off with myself here. So Monica's sent in something saying, I'm terrible at investing little and investing often. I tell myself that if I don't invest, I need big chunks at a time. I can't do it. How do I change? And there's a lot of how do I change that mentality? And that's a really good question, because when it comes to money, it's more than just dollars and cents. It really does have that money mindset. For me, Monica, I basically do forced savings. I treat my investments like a subscription, and I automate it. So that's the first thing I think you need to have a look at. There was a lot of questions on minimum investment. 10,000 is the minimum investment, but you can get into fund later for 4,000. Now, I was actually sitting on the board when this product was developed, and I loved the concept of it because for me, it's for savings. It's one of those ETFs I did pick up because I was just interested in it. And I've got to say, I have just finished. The way Fund Later works is basically you make installment payments, $325 is a fee, $300 pays off the $6,000. So you put in $4,000, InvestSmart puts in $6,000. And there's no recourse, there's no kind of margin calls on it, but I urge you have a look online if that suits you better and see if that suits you. It may not, but the reason I love it is for savings, which goes back to what my first tip was: automate your savings, treat it like a subscription. You never miss a Netflix subscription, so if you set up your investments or saving goals that way, you won't miss that. Paul, I'm going to go to you now. I'm really curious to see, have you ever made a bad investment?
How long have you got?
We don't have a lot. I notice it's one now. I'm mindful of people on their lunch breaks. And yeah, if you can give me a short answer.
Okay, very quickly. You know how you can't lose money on property? You all know you can't technically lose more than 100%. I managed to lose more than 100% on a property. Myself and my uni mates in the pub one night, many moons ago, speaking. Well, we couldn't afford margaritas back there, Tom. We would have been drinking VB. But we decided to spend $17,000 in Mount Beauty, Victoria, on a little old house, which we were going to knock down. Between about 8 or 9, we put in a couple of grand each. And we knocked this house down, which costs a bit of money. And then we were going to build a ski lodge, was the plan. About 12 years later, we hadn't quite got around to building anything. And so we actually ended up selling our $17,000 property for $10,000. It cost us $1,500 a year to slash the blackberries on the property for 10 years. So we actually managed to lose more than 100% on property in a perfectly good location. We just got all the dynamics wrong. We thought we could do it. We didn't get round to it. It was a great idea at the pub, okay? So I strongly suggest any investment thoughts you have, just don't do it at the pub, okay?
Sounds good. Alastair, what about you?
Well,
or maybe
worst
funds
investment.
manager.
Yeah. I'm trying to forget all these ones. They give me nightmares, some of them. There was one, there's one, the one I do remember, and because it was part of Australia, part of Australian folklore when it all happened. It was a broking business I worked in, and down the pub, all the guys said, "Oh, you've got to buy this stock," and it took off. And I said, "Oh shit, what does it do?" It was called Cambridge Golf, and it had this plan to suck diamonds out of the floor of the Cambridge Golf. And of course, this company's going to be worth $10 this year, and I think I bought them at about $2, and it eventually went bankrupt. Actually, quite quickly went bankrupt because there's no diamonds. And they raised a lot of money, and it all disappeared. So it wasn't fraud, unfortunately, because I thought I might get something back, but it was near enough to fraud.
Oh, gee, gee.
Steer clear of pub tips now.
Oh, so true. Tom, the Margarita Fund?
Yeah, that's just it's not actually growing for some reason. I don't know why, but I was going to say my dog, but no, she's actually paid dividends recently, so that's okay. But I remember getting caught up in this idea of investing in Slater Gordon when it launched. So a lot of the hype about some of these new companies that were coming onto the market, I got caught up in. And I think that's what I've learned about is obviously steer clear of when everyone's screaming red and the markets are down 1%, but also the opposite too. Watch out for some of the hype with a lot of the stocks that are just entering onto the ASX.
Thanks, Tom.
What's you, Effie? Come on, what's yours?
Oh, we don't have time. It's 1:03, and I do want to say that all the information here. Obviously, this is not financial advice. This is not financial advice. If you want to take anything up further, please do get expert financial advice. And all your questions here. I noticed there was a few tax questions. Is the $550 per annum fee tax deductible and so on? We are doing a special tax newsletter coming out next week. So we'll be sure to put all those questions that we're getting around tax in that newsletter as well. We really appreciate your time on this webinar. Thank you so much. Thanks, Tom, Alastair and Paul for your time. And guys, if you need anything, you know where to reach us, email or the phone numbers there on our websites. We'd love to hear from you. Here's to your financial success and until we meet again.
Thanks.
Thanks, Effie.